Hello and a warm welcome to VAT Update from Tax Essentials for Advisors. I'm Ed Thompson. In HMRC news this week, we'll be looking at some updated guidance on the UK Import One Stop Shop, or IOSS. In cases news, we've got two cases, one on pre-registration input tax and how much pre-registration input tax can be recovered, and the other looks at some anti-avoidance rules around the disapplication of the option to tax. In our VAT tips, we'll stick with the option to tax theme and look at the option to tax as a VAT planning tool. We've had a collection of new guidance pages published by HMRC on the UK's Import One Stop Shop scheme, or IOSS as it's known for short. The IOSS can be used to report and pay VAT on imports of low value goods to consumers in the EU and or Northern Ireland. The point of the IOSS is it's a simplification. The VAT can be declared and paid on a single IOSS return rather than having to register for VAT in lots of different jurisdictions. From the 1st of April 2026, for the first time, businesses from outside Northern Ireland and the EU will be able to register for the UK IOSS using an intermediary with a business address in Northern Ireland. However, there is a sting in the tail for those intermediaries that should make you think twice. The intermediaries will be jointly and severally liable for the IOSS VAT debts of their clients. Our first case this week is Aspire in the Community Services Limited. It's a first-tier tribunal case about a partly exempt VAT group in the welfare sector, which was trying to claim some VAT on goods and services incurred before its effective date of registration. HMRC allowed them some VAT recovery under the pre-registration input tax rules, but having done this, they then sought to restrict the amount of VAT recovery by reference to exempt supplies made prior to that effective date of registration, and not just looking at the partial exemption rules as they applied from the date of registration. The first-tier tribunal held that HMRC weren't allowed to look at usage before the effective date of registration to determine the VAT recovery. The result? A much higher level of VAT recovery on these pre-registration costs than would otherwise have been the case. HMRC sometimes tries to insist on these pre-registration input tax restrictions for exempt supplies, so this could be good news for a number of taxpayers. Our other case this week is another one that was heard by the First Tier Tax Tribunal. This one is about a favourite topic of VAT advisors, the option to tax. And in particular, it's about some anti-avoidance rules that result in the option to tax being disapplied. In other words, when these rules kick in, an option to tax has no effect and a standard rated sale reverts back to being VAT exempt. Here, you had a company which was letting a building which it had opted to tax and on which it had recovered a lot of VAT to another company. That other company was wholly VAT exempt. It was operating a nursery. Because the nursery company had made some payments to the first company with the intention that the funds would be used towards the property, it was regarded as what's called a development financier for the purposes of these complex anti-avoidance rules. And this meant that the option to tax of the first company was disapplied and our company was not entitled to recover the VAT that it had incurred. As we've just seen a case on the option to tax, it makes sense for our tax tip today to focus on precisely that. The option to tax is a key VAT planning tool. The idea is that it turns supplies of land and buildings from VAT exempt to standard rated. Why do this? Well, as we saw in the case, it might help us recover significant VAT on property costs. So to take an example, if I'm renting out a commercial property, the default is that rent is going to be VAT exempt. But if I opt to tax, then my rents will become subject to VAT at 20%. If I then incur a large amount of VAT on a refurbishment, I might be able to recover the VAT rather than have to suffer it as an additional cost. Whether to opt to tax is going to depend on the circumstances and especially on the status of my customer or my customers. If, for example, I'm renting that commercial property to a fully taxable business who can reclaim all its VAT, then the chances are they won't mind me charging VAT on top of my rents, which means there's considerable upside for me. However, if I'm renting to someone who is largely VAT exempt, an insurer for example, they might not be happy to pay VAT on top of the agreed rent. You also have to look out for those disapplication rules. They're most likely to kick in where there's a person occupying the property who isn't able to recover all their VAT. But the detail of the provisions is complicated. And although they're described as anti-avoidance rules, they actually operate quite mechanically, and they can kick in even when there's no tax avoidance motive going on at all. Thanks very much for listening, and I'm looking forward to our next VAT update in a couple of weeks' time.
Thanks for that, Ed. In case you missed it, our webinar on making tax digital took place at the end of February, and it was packed with helpful information. You can view it on our YouTube channel at the link shown here. Bye for now.